Welcome back to Squawk Box here on CNBC. First in business worldwide, 216 now. We're looking at in Dow futures. We're 1 hour away from the opening bell. We had a lot of Dow earnings. The one that is trading higher is McDonald's at this point, but it's even given back a little bit of its gains. Let's get back to our conversation about the markets and the economy. Rick Santelli, ACA, the Weenus, is at the Board of Trade. That's Steve's new name. Nouriel Roubini, chairman of RGEMonitor.com, is here. Jack Rivkin, former Neuberger German CIO, is here, and our senior economics reporter, Steve Leisman, who actually coined that term, is also here as well. Let me start with you, Rick. I said earlier, the stock market was up Monday. We've already gotten our bounce for all the LIBOR tightening and all these good things happening in the credit market. Now we've moved on. They're thawing, and now we're worried about the economy. We only got 1 day, Rick.
Do not enter.
Well, I'll tell you what, it's nice not to be alone. Dr. Roubini and I think, share some common thoughts about the future. But I will tell you this. If you're looking to the equity markets to give you a reality, I don't know that you're going to get it. And if you look at short-term funding markets, as all these little detours on an expressway that has holes in it are moving traffic, you're right. But believe me, there's an awful lot of congestion for other areas of the credit markets. So I think it's going to continue to be more of the same with slight improvements.
Steve, were you surprised that the relief of the initial signs, the preliminary signs of the credit thawing, that we're not sort of in a better mood?
No, Joe, and I think it's a real good news, bad news story out there. What I look at is it looks to me like the Fed finally has the amount of funding needed in the interbank market right. It had recently the 2 most successful term auction facility auctions that it's had so far of the 25. I think it was like 290 and 265 below LIBOR, and that together with the $540 billion put to the money market yesterday were responsible, I think, for bringing down the interbank lending market. That's on the one side over here. That's bank to bank. But on the other side, you have a bunch of reports, Joe, that show corporate bond defaults are going to go through the roof here. And that's a real economic signal of what's
Steve,
going on.
Based on current pricings in corporates, my buddies tell me expected default rate around 5.5%.
You're too low, my man. I just read another report. I mean, obviously it could be that. I don't mean to dismiss it like that. But I just read a report, Rick, that said 7.6%, which would be really, be triple the current level. In any event, we can both agree, Rick. Let's find the common ground, my man. Let's find the common ground. We can agree that it's going to get a lot worse from here. There's a lot of distressed debt out there.
The high water mark on corporate defaults was 8.6%, to give you a little perspective.
So that would be, we'd be up there and close to it. The trouble is, Rick, as we both know, there was a lot of speculative funding that happened during the days of cheap money. The way I think about this, Rick, is that there was a lot of cheap money that got people mortgages they didn't deserve. There's a lot of cheap money that got corporations funding for LBO they didn't deserve.
Right, and just, let's put a little perspective, though. If you look at where good investment-grade loans are trading, they're trading around 66 cents on the dollar.
Amazing.
That's actually a good thing.
Why is that?
Because it gives you enough slippage that they've priced probably
too much beyond the recovery rate. Yeah,
yes.
Right. No, I think that's true, and that's really where the whole investment strategy comes from right now, which is where do you come in the capital structure? Do you come in and buy so-called undervalued equities, or do you come in on the top here and buy so-called undervalued investment-grade corporate?
This is easy. Dr. Roubini will back me up. Since we're in a social democratic society now, what you do is you buy the securities of the banks that have the FDIC guarantee.
Exactly.
That's a layup.
Dr. Roubini?
Yeah, I think that the most important key point here is this is not just a liquidity crisis, this is a credit and solvency crisis. So, yes, the Fed is flooding the markets with liquidity, LIBOR spreads are falling, but these default rates on corporates are going to skyrocket. In the last 2 recessions, they were short and shallow. Default rates on speculative grade bonds peaked at 13%. The last 2 years, those rates have been close to zero. So starting from zero default rates on corporate bonds for speculative grade, you're going to have, even in a minor recession, something above 10%. And this is not going to be a mild recession. So I think that's the next time bomb, really a significant increase in default rates for corporates. And recovery rates during a recession in a normal year are 70 cents on the dollar. In a recession year are something like 35 cents on the dollar. You get the double whammy. Much higher default rates, much lower recovery rates. That's going to be significant. It's going to also lead to a significant systemic effect on the CDS market once these corporate default rates go sharply up.
Nouriel, I want to know what the biggest, best, brightest bear in the history of the economy here, meaning you, has done with his money over the past several years and what you're doing with it now.
I'm not an active investor. I put everything passively into index of equities globally. I'll keep it until I retire. But if I was an active investor today, I would keep things in cash and in safe treasury. I think there is significant downside risk to equities, to commodities, to housing-related stuff. Even credit spreads that widen a lot are going to widen even further. This is going to get really ugly.
Hey, Rick, Nouriel said 2 years, and Steve, 2 years of negative GDP growth. 2 years. You think that's possible, Rick Santelli?
You know, truly, Joe, I think anything is possible. I think in a global economy, and I've given my analogy before, the globalization that we're experiencing makes the pool much deeper. So the splashes around the periphery are choppier. That's what we're in now. But I do think that you could get traction with all these programs, and that could help. The real problem, I think, is how to extricate the government from all the pricing that they are distorting, because once they're in, it's like Freddie and Fannie. Everything looks good, but can they ever really get out?
I agree with Rick on that the government programs create the possibility that it may not be as bad as Nouriel says. The key issue here is going to be how and when the government gets out. If it can execute both the getting in and the getting out in a good way, then maybe the worst-case scenario put out there by Nouriel of 2 years. A lot of guys I'm talking to still, Nouriel, and I know you'll probably laugh at this, are looking for a rebound in the second half of 09, even though they may be close to where you are on unemployment. I heard you say 8 to 9% in the last hour. They're thinking more 7.5 to 8 here. Maybe we get off cheap there.
It's not a question of how and when, but also if. I mean, people didn't think the Fed was going to, after the recession, things changed forever, and they didn't go back.
The mantra on the floor, Carl, is what are they going to get out of first, Amtrak or the banking system?
Listen, we've gotten to the point in which central banks used to be the lender of last resort. Right now, central banks have become the lender of first and only resorts. Nobody's lending to the banking system. Nobody's lending to other financial institutions. Nobody's lending to the corporate sector. That's what we've gotten to.
Jack, you've got one chart you should show us. We talked a lot about how the economy.
Well, if you want a little bit of good news, there